Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this month's LONGWave video, I'd like to update our Strategic Investment Insights or SII activities and our current thinking. As such, I would like to cover those items listed here. Since we began presenting SII updates, we have discussed the two tectonic forces at play in the markets, the natural force of the end of the debt supercycle versus the managed monetary actions of the global central banks. In 2018, the central banks took their foot off the accelerator with the Fed's normalization program of its balance sheet or quantitative tightening, the Fed going on pause with regard to its Fed fund rate increases, the ECB, or the European Central Bank, stating its intention of tapering its monetary policies, the Bank of Japan's intentions of slowing the rate of increasing easy money, and the People's Bank of China indicating its intentions of slowing its liquidity injections. As the red labeling at the top of this chart shows, the markets were starting to go parabolic and clearly had disconnected from historic valuation metrics. The Fed funds rate shown in red was halted, with the last increase in December 2018 when the markets reacted violently, leading to the Treasury Secretary's Mnuchin massacre on Christmas Eve when it was rumored he was forced to call in the infamous PPT or Plunge Protection Team. The Federal Reserve's Fed funds rate had reached the upper bound of rate increases, which usually is signaled by an unpopular market adjustment. Since the Fed always follows the two-year Treasury bill market, which was falling in yield, it was clear to the financial community that this was the end of this particular tightening cycle. The Fed's quantitative tightening, or balance sheet normalization program, was only just beginning to take effect, shown here in black, but the reduced global dollar liquidity was being felt globally and abruptly came home to roost like a sledgehammer in Q4 2018. This particular chart of the S&P 500 you have seen continuously since we started posting it in 2018. It shows our expectations for a head and shoulders pattern with a neckline completion at the labeling small a in black at the bottom of the chart. We didn't get the typical W bottom we expected, but we were extremely close in price and time with a bottom price print as part of our expected January quadruple witch. Our right shoulder also was pretty well right on, and as a consequence, our SII performance has reflected this in the first half of this year. What happened is the central banks once again took control, with the Federal Reserve halting any further rate increases and reversing its tightening policy guidance. The ECB's guidance of tapering was put on hold. The Bank of Japan continued its easy money policy and in fact increased it. A critically important catalyst was the People's Bank of China suddenly injecting an initial $1.1 trillion in liquidity injections. We are off to the races again. You can see that the dramatic increase in global money supply directly correlates with the lift in the S&P 500 and overall equity markets. Since then, we have seen further policies of financial easing. The Fed has signaled easing and rate cuts from simply halting rate increases. They then announced that they plan to halt quantitative tightening in September. The ECB is now signaling a resumption of policy easing, and the Bank of Japan has continued easy money and is considering new ways of increasing it. The People's Bank of China has further accelerated its target liquidity injections. Subsequently, the S&P 500 delivered our right shoulder and even more, in fact. It delivered a double top. As a consequence, what has happened is our head and shoulders pattern has potentially now been inverted, and we could now have the possibilities of an inverse head and shoulders emerging as shown here. This means higher S&P 500 levels after a likely shorter term consolidation. The S&P 500 chart was drawn at the red small a and was part of the S&P 500 subscriber video at Meta SII. We are actually quite surprised how precisely our elliptical theory chart has called the price movements in the SPX since its inception. It has given us a lot of confidence in the potential inverse head and shoulders pattern, which could take the S&P 500 to 3,050 before the final top is in. What all this translates into is a continuation of our prediction of a Minsky melt-up, a chart many of you no doubt are getting tired of us showing, but is still very much in play. We posted this schematic in May of 2018, marked today. We are now at the red arrow. We have experienced the actions in both the high yield sector and the treasury yields predicted. The yield curve is now inverted, and there is strong evidence that a recession is extremely close, if we're not already in it in the United States. Though this chart has been amazingly accurate to date, it's now potentially misleading because of the degree to which the central banks are aggressively reversing monetary policy. And monetary policies we've never seen before, I suspect, are on the drawing board. Yes, we are in the late stages of the credit cycle. Yes, the rest of the world is further along than currently showing in the U.S. in the end of their particular business cycle. However, the late stage credit cycle may last longer than presently anticipated by the markets if the central bank money spigot is once more open to full throttle. Remember, however, this will only delay the inevitable, and therefore the coming global U.S. recession will only be that much longer and more painful when it does finally occur, and you can be certain that it will occur. We will get into the charts that go with the grid shown here in the upcoming Under the Lens video, but suffice it to say that the next global central bank round of easing will be different, much different. What the grid shows is the steepening differential that has occurred during prior recessions. We're not talking about the inversion that warns of recessions, but rather what happens during and as the recession ends. In the recession of the early 1990s, the 10-year yield dropped 5.5%, while the Fed reduced the Fed's fund rate by 3%. This gave the banks 2.5% to work with. We see the dot-com bubble gave the same 2.5%, but the 2008 housing bust only gave us 1.5% as the Fed reached a zero bound on the Fed funds rate. In the next recession, it is likely that the Fed's funds rate will be forced into negative rates. Currently, we have globally close to 13 trillion US dollars in negative yielding bonds, but have not as yet had that situation in America. That will change as the recession unfolds. Effectively, we will be paying banks to take dollars, and banks will be charging large depositors to hold their dollars. There are significant consequences of this since the US dollar is the global reserve currency and US Treasuries are considered the benchmark for risk and the risk-free data point. Disruption here simply have unknowable consequences. Until this occurs, our 150 plus number of SII watch list instruments and 13 sectors need to be watched closely through our tracking analytics engine for repositioning and reallocation trends. We have already witnessed this occurring in 3 of our late cycle sectors. Healthcare, utilities, and consumer staples have all been steadily performing as more and more funds adjust their allocation mix. We will continue to add to our watch list for these and other defensive sectors as merited. In the area of bond and credit, we fully expect to see the bond yields fall much further and gains to be made on bond price while locking in yields. However, there are cross currents at play, such as a potential trade war inflation shocker, continued flight to safety, and shifting cross-border yield differentials that need to be watched closely. We have argued for some time that near term we are likely to see a retracement of the recent drop in treasury yields before attempting to head lower. This is one of the reasons we call 2019 the year of the right shoulder. All bets are off on lower long-term bond yields if foreign buyers in total continue to reduce both their holdings and rate of buying while U.S. supply explodes with increasing deficits. The only way around this is for the U.S. to sacrifice the dollar. We expect this to occur. We are close to a dollar high and likely at the beginnings of a steady erosion in the U.S. dollar. We have long believed the dollar would be the last to fall in a massive fiat currency failure, but this doesn't mean it won't be preceded by a steady fall in fiat currencies. Our longer-term dollar charts are showing how close we are to a critical inflection point. We've shown both these charts many times previously, and since the central bank reversal in Q4 2018, they have only continued to worsen. We think this will be positive for hard assets like gold, silver, platinum, colored diamonds, etc. We've already broken long-term overhead resistance in gold, which we warned about in numerous posts prior to the recent $160 an ounce advance. The technicals haven't been this strong in nearly 10 years, and the recent performance in our watch list performance is highlighting this potential opportunity. Never forget that tops are a process. The process entails sector rotations not only within equities, but within, maybe more importantly, the bond, currency, commodity, and credit markets. The next recession is going to be a challenge, so get a strategy in place now, not only for equities, but all the other markets included, where maybe even bigger profits will be made. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of unsound money and fiat currencies. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2019 be an outstanding investment year for you and your family, and I sincerely thank you for listening.